Ladies and gents, good evening to you, wherever you are tuning in from 6 o'clock London time. Dow is actually down a little bit today, even though when you look back and you scroll through your chart, look at my other screens here, it's pretty much right in the smack bang in the middle of April's range. We've gone up a bit, down a bit, left a bit, right a bit, and we've not done a lot. But today's a little bit more spice than we used to. Currencies, yeah, again, it's a bit quiet at the moment, isn't it? We haven't really broken out of many ranges. It'd be interesting to see where we end the month and if it is a sell in May, go away type scenario, or we get some spice. I know everyone's looking at inflation and all that other good stuff, but I'd like some volatility. I just like a bit more volatility. But hey, market is what it is. Can't force it. Can't get frustrated by it. There's opportunity, but it's a kind of single shot strike. Take your opportunity. Works great. And that's the downside, right? Before we go on, that's the downside of a volatility crushed environment is you don't get the opportunity to take another trade or another trade or another trade. It's kind of you take maybe one or two trade ideas and then you've got to wait until the next day if there is something. But that's part of being, disciplined and patient trader. Okay, so ladies and gents, what we're going to do today is we are going to run for about 40 minutes or so. Then it can time for some Q&A after that. If you would like to put your questions in the Q&A section, the questions section, I think it is, then feel free and I'll get to those at the end. All right, disclaimer, usual disclaimer, ladies and gents, we have a risk warning. Be very careful about trading, especially when you're trading with leverage. It's not suitable for everybody. Hopefully you know the score by now, but if you're new to trading, then obviously please understand this is a risky business. Good rewards, but there's a lot of risk there as well. Okay, so let's move on. So this is a 3-part series. If you are brand new to this webinar, this is the second. You will, I think, be sent the recording of the first if you haven't already, so you'll be able to get all of them. But really, this is a masterclass mini course, if you like, into short-term order flow analysis. So we're digging right into kind of understanding price action on a very short-term basis, and how we can use it as a skill to improve our execution in our trading. There's no holy grail here, absolutely not. That's not how it works. But I do believe this is a skill that will help you, improve your trading, even if it's just stop taking substandard trades or reduce the amount of substandard trades you take. I think it's a skill that you can build on over your trading career. I started trading in 2001. And this is something that I really got stuck into sort of 2003, 2004, that sort of decade. And it's a skill that I've sort of built on and I've adjusted and changed and tweaked and adapted as I've sort of grown as a trader throughout the years. So those of you who are regular here know I like to put a Stoic quote down here from one of the Stoics, Epictetus this time. Make the best use of what is in your power and take the rest as it happens. So how do we parallel that with trading? Of course, with trading preparation, discipline, sticking to the risk rules, sticking to the trading plan, and the market does what the market wants to do. We can't force the market, just like we'd love to ramp up the volatility knob, but it ain't going to be like that. It's the way it is. So take the rest as it comes. We can control what we can control. Okay, so let's talk about the topic of this week, which is the price action playbook. Last week we talked about decoding that market microstructure. Okay, so we went into kind of understanding the participants. They are time sensitive or they're price sensitive. Talked a little bit about supply demand, which I think is super important to understand before we kind of go further. That's why I wanted to chunk this up into 3 different webinars, and really kind of understanding the urgency of price, the kind of movement, who the participants are, why they're driving the market. We talked about the stop hunting technique and that stop cascade tactic, looking at a specific level. That I won't go into too much detail about that. You can check that one out. And those of you who were here before, great feedback on that. So thank you for that. Detecting those subtle supply-demand imbalances. And next week, we're going to be talking about kind of this trim and trail technique on the 15-second chart, more on the 15-second chart this week, turning those scalps into kind of day trade, into swing trades, if that's your bag, and kind of really maximizing that risk reward ratio. Of course, you're not going to get them right all the time, but if you can get one and kind of fine tune it and make it in the right place at the right time, that short-term scalp can become a day trade, and then maybe you can consider holding it a little bit longer. And the Amber scalping tool that I've had developed by a developer I worked with, this chap a while ago, went back and forth to really kind of formulate these ideas, these to spot these mini exhaustions. And I gave him multiple parameters for that, and he's come back with a trading view code form. We've had this for a while, and what I'll do is, sort of the latter part of next week's webinar, we'll go through how to set that up. And the reason I'm kind of bringing it to the end is all these concepts that I'm sharing with you that I feel like you'll get value from, that will improve your trading last week and this week, kind of they all line up to what this tool does. This tool kind of takes some of those concepts and not automates, but maybe takes a little bit of the cognitive load away from you and says, okay, hey, this might be a way where you can look a little bit closer. So I didn't want to kind of throw it on you now and you just go download it and go, this doesn't work, it's rubbish, doesn't do anything. I want to kind of build up the reasons why I came up with this tool and some of the parameters and all this kind of stuff. So make sure you log on next week for that, and I'll give you obviously your copy and you can download that and do with it as you wish. All right, so this week, let's get rolling. 15-second chart hack, decoding pace of price changes. Oh, I like this type of stuff. God, I'm just a nerd when it comes to this. I love price action, especially on a very short-term basis. That pulse of price, going to go into that. And by the way, please, questions. If I've gone too advanced, if I'm going over things too quickly, I do have a habit of that because I'm passionate about it. It's been my passion for the last 20 plus years. So absolutely, if it's something you don't understand, please just put it in the questions. I'll get to it at the end, and if I can answer it, absolutely will. If I can't answer it, I'll probably direct you to somewhere that maybe has more of a deeper understanding of things. I've got a lot of experience. The market's been kind to me over the years, but I don't pretend to be an expert at everything. But I do know other people that may be able to help you out with the question. But I probably can answer most questions and help you, or at least guide you. Chunking method, that's when we're kind of taking the price movements and price pauses, pulses, pauses, and drives. You're going to love this one. And then drills to kind of improve your price action. All right, so let's get cracking. We're on time. We're good. What is a 15-second chart hack? So that means kind of self-explanatory in a way. When we go down the time frames, we go down and we get more granularity, right? And the 15-second chart is something that gives us, I find it's a sweet spot. I've been brought up. I've used the 1 minute chart for ever since I started trading. That was kind of my go-to thing. And I scaled myself back and went to the 5 and 15 and get a bigger bird's eye view of things in the daily. And then, but I've always felt comfortable executing on a 1 minute. And that was really always available. And then you can go deeper and start to subscribe to level 2 and all that type of stuff if you like. But actually, I feel that the 15-second chart hack is a way to really see price movement and price response and price, little nuances of price without having to kind of go any deeper. And it gives you a really good overview. So if you're trading a CFD product, you're trading a spread bet product, this is something you can use on your chart, use on TradingView, and it's going to give you a very good insight into what's happening under the bonnet, if you like. So, and we can spot these little price changes. So one sort of caveat to this is, as with all these type of things, is we only want to use it at important levels. If you're going to sit there and stare at a 15-second chart, then you're just going to go crazy, right? You're just going to go crazy because your discipline will relax and you end up doing something you don't want to do. You'll see things that aren't there like a mirage. It will just seduce you into trading something that's not relevant. So you've got to use it as a tool that is just like a magnifying glass, right? Don't go around with a magnifying glass up on your eyes looking around because you don't see anything. You're not bumping into stuff and doing damage, right? Stupid analogy, but you get the point. You use a magnifying glass when you want to look at something a bit closer. And that's what we're doing the 15-second chart hack. And by the way, I would probably go so far as to say that's probably a good rule of thumb for all your short-term time frames, is to only look at them under certain conditions. Don't fall into the trap that beginner traders do. Hands up, did this. Just looking at that 1 minute chart, looking at that sort of 15-second chart. Go back and zoom in when you need to, because that helps really keep your focus reserves as well, so when you need them. All right. So I say I'm going to go through stuff and I'm going to kind of chop back and forth a little bit. Questions, more than happy to answer those. So imagine this scenario. So the other day, NASDAQ 100, Pepperstone's equivalent, reversing off the highs. And most people, and this is why I wanted to kind of, mention this at the beginning, the beauty of understanding these short-term nuances of price and reading into it. And by the way, this is not holy grail. And if you know me, that's not what I'm about. There is no holy grail. It's about developing skills and knowledge and these ways of viewing things that help you just become a little bit of a better trader. And in this example, this is something that you would have used to avoid getting caught in a trade that you might otherwise have taken. And I'll explain why. So imagine this chart. You kind of saw it So the price sort of pushing up, comes back down. It's pretty steep, but maybe it's come back to that VWAP and that cluster of support over on the left-hand side earlier in the trading day. VWAP's there. You might have seen that overshoot and stall and gone, okay, it's just a bit of an overshoot. You know, I might buy this. But actually, when you go, and this is a 1 minute chart, by the way, when you go into a 15-second chart, it reveals something a little bit different. And at the and I'm not saying you'd short this, maybe you would if that was your idea, but you might look a little bit closer at the 15-second chart and at least stop yourself from buying, which is kind of part of the game. On the 15-second chart, we can see like these finer details, right? We see this kind of consolidation area. We see the fact that prices really struggled to push back up. And if you think about, you know, what's actually happened, we've driven through the VWAP, driven back to these key levels. We'll talk about chunking in a moment, that technique of chunking. I don't want to go too far ahead of myself. But, you know, if you think about what's actually happening here for an auction process, we've got supply, little tiny 15-second wobble at the VWAP. That's just going to almost always going to happen. Be careful what I'm saying. You know, it's a common thing to happen, right? VWAP, there's often orders sitting there, and without kind of going off topic, there's algos that are VWAP algos that will be well aggressive and much more aggressive at the volume weighted average price. So you're probably going to get that little pause, which you often don't see on the 1 minute, but you see on the 15-second. Runs through again. But then what's happening here is, you know, we're really not really struggling. Like the biggest candle we've got is literally over 15 seconds. And so you really start to get an insight into, hey, there's no persistency of buying. You know, that 15-second candle push back up immediately, you know, it's met with resistance, right? And we end up coming back into the candle, and yes, there's a little bit of movement, but just think how much that is. That's nothing. That's a couple of ticks, right, over that you know, multi 15-second chart bar period. And so you start to get an insight and go, hang on a second, if I think about what's happening, there's a seller pushing. Yes, there's a buyer, absolutely. And of course, for every seller, there has to be a buyer. But yes, there's a buyer holding this, and that seller's not willing to pay any lower. If he is, the buyer's scooping it up. But how aggressive is that buyer? Every time he's stepping up a little bit, it's getting pushed down. And we start to see a little bit more granularity in price. We're going to go into it in a bit more depth in a moment. But I just want that concept to kind of come into your mind and think a little bit about the supply-demand shift, about what causes price to move, price urgency, time sensitivity, price sensitivity versus time sensitivity, and that type of thing. A little zoomed in sort of view here of what I was talking about. The majority of the move off the lows was just a 15-second jump. It feels to me when I see this, like it's a big order coming in. Someone's just gone, boom, bought a load, and that's it. And that's the sort of insights that you try to gather from looking at these charts and looking at these kind of nuances and go, hey, hang on a second, if it was persistently moving and maybe it was holding and maybe we get another green that might build, we don't see that. We see selling hitting it straight away. And yes, it kind of drifts up a little bit higher, but after that, you know, it just starts to roll and it just looks weak. You can just feel the weakness there. Like I say, maybe you wouldn't want to be shorting right on the lows after the highs and through the VWAP. I understand that. But you at least would go, let me just wait a little bit. Let me just see if I get one more test below the low before I consider the long. And of course, it goes to the low and it carries on going. So it saved you from getting long and getting stopped out. Not always the case, but this is kind of what the skill we're trying to develop here. All right, so just look at my other screen here, guys. Okay, so what are we looking for? What are we really looking for? We're trying to really understand how price behaves at these key levels. And at the end of this, I'm going to give you some drills to kind of help improve your read of this. So, you know, stick with me. If there's some of this stuff is like, oh, you know, can't quite get it, hopefully it'll click. And really, if you add it into some screen time, some drills that I'm going to give you, then, you know, over time, it'll start to click and you'll be like, yeah, that makes sense. So, you know, bear with me for now. So we want to think about how price is approaching the level. And that's really important. And you know, right? You know, you're a trader, you sat in front of a chart, you know there's a lot of difference to price that just really creeps up and just grinds and sits there versus price from straight up there. Now the price is still the same. If you just read, what's the price of the current market? And it was said, oh yeah, it's you know, 7,500. That's fact. But how it's got there is where us as short-term traders can decipher potentially whether we're going to get a breakthrough, we're going to get a hold, we're going to get reversal, and try to build the clues to determine how we're going to position. And we might and again, going back to the defensive nature, it might be that there's no position, right? We don't take a trade. It might save us from taking a trade, or it might be that it gives us the clarity and the confidence to pull the trigger and take the trade that we've been planning beforehand. And this is the final piece of the puzzle that fits together and says, hey, I like this. The speed is right, the pace of price change is right, and general feel is right. Okay, so those are the things I want you to think about as we go to the next couple of slides. Is how is price approaching the level? How is it behaving at the level? And just really zoom out of all your other technical analysis stuff. There's nothing wrong with that, absolutely. But at the moment, we're going deeper. We're going more advanced, and we're looking at the nuances on those kind of chunk of 15-second candles. So as we do that, right? So how does price get to a level? How does price behave at a level? This is where we get a little bit more active, right? And we start to what I call chunk price. And chunking price is really a mental count of where price has been. So we've got the chart, we've got the areas, and you know how to draw your key levels, and you know how to come up with support and resistance levels, and you know the key levels of overnight highs and prior highs and lows and all this type of stuff. You know the levels that are of interest to people, to participants and yourself. But chunking price is where we say, okay, let's watch how price responds, because you know as well, if you're an active trader, you've got to be on the ball. You can't be messing around overthinking your trade and like, oh, I need to double check this and that, because the trade's gone. And yes, it might still be valid, but the risk reward structure of the trade has changed massively, and it almost negates the value of the trade. So we want to be sharp and want to be able to take a little bit of risk. And maybe this is considered as an aggressive way of trading. I don't know. I don't care. You know, it's kind of if it suits you. So really, let's go back to chunking. So chunking is this mental count of where price has been recently. So we bracket this short-term movement. So imagine we had price and whatever the front numbers were, but imagine it was 12, 13, 14, 15, 14, 14, and you saw this on price. And really what we're doing here is we're putting our order ticket in rather, and obviously you can look at it on the chart, but we're kind of watching price change. In the old days, if you read Reminiscence of a Stock Operator, they'd have the tape coming through, tape reading. So they'd have the tape coming through the ticker tape, and they'd read this 12, 13, 14, and they would be bracketing this short-term movement. So we're doing the same type of thing, and we're trying to really get a granular magnifying glass on price. And so in this kind of example, and we'll have some charts in a moment, we've got a mental bracket of price changing between 12 and 15, right? We're removing the noise. Yeah, this is the key to this. We're removing the noise of the price in between, and we're just chunking the high and low of that very, very short-term bracket in our mind, and we're adjusting the bracket as price moves until it gets to a position where we're ready to execute a trade. So we're thinking in our minds, okay, 12, 13, 14, 15. So we're watching price change, back up, price change. Not getting sucked into the noise yet. It's not ready. And then when we see some change in sentiment, some change in the pace, or the change of price, or the change of how it breaks out the bracket, that is an indicator for us to potentially get involved. Again, we'll talk about that in the next couple of slides. So creating that mental bracket as price changes. So imagine you're looking at a quote and price is changing, prices are up and down, 50, 51, 52. And we're creating this mental bracket in our mind. Now we have these little extremes, right? And these aren't something necessarily you can draw on the chart, because it's not a prolonged resistance level or prolonged support level. It's a way that we can very, very short term say that's the high, that's the low. And then if we go back to week one and we talked about, you know, who the buyers and sellers are, maybe there's a short term buyer and seller holding that price on the order book. We don't know, we don't really care. We just know that's the very short term bracket, and we've chunked it. We've got rid of all the noise in the middle. And we said, okay, as we move out of that bracket, that's when I'm going to look to take the trade. If we move out with pace, with some gusto, with some strength, with some force. And so this time we're early on the move, as opposed to waiting. And by the way, you know, in these sort of conditions, you want to kind of be a little bit more, again, it's my not recommendation, it's my approach, is to be a little bit more aggressive with your executions, because you are taking kind of, you know, outside in type trades. You are trying to catch that pulse, and the drives aren't as big. So being a little bit early does in you know, my perspective, pay off a little bit better than waiting. By the time you wait for all this confirmation, the move's done. So this allows us to kind of chunk and bracket price. So it's a good example, right? It's an example, because I understand this is an unusual concept. So 1 minute chart here, we've got NASDAQ equivalent on Pepperstone. Market's kind of pushing. This is a swing low, right? It's a swing low from the prior couple of hours, and we're hitting this level. Pretty normal stuff, right? Pretty normal stuff. So let's think about how we could use this chunking method and understand what's going on. So we flip to our 15-second chart, and we start to look at what's going on. Right. So our prior low is the area we're interested in. That's the swing low, 12,983. Fine. Now, as price is kind of penetrating through that, we start to see how price is chunking these highs and lows. We start to say, okay, listen, price is trading between 76s, that's the low, to 80s, and then 80s to 85s. We see this kind of this little area here, and then it breaks out, does a little bit more, then it comes back in here, and we're watching to see the response when it's coming back up to those key levels. So as it's doing 76s to 80s, we're sitting there watching it breaks through. We're like, okay, now maybe you scalp long on that. Maybe you don't. Maybe you're looking kind of for something bigger. Maybe looking for the short opportunity. Whatever you're kind of trying to line up with your roadmap for the day anyway, or your trading plan or trade idea. But then you'll kind of make a new bracket and go, okay, we're 80, 85s. But this is the way that it gets interesting, because when you go, okay, we've broken through the 80 and we're running straight up to 85. What's the response? When we go back to what's the price response, the price response is immediate rejection on 15-second. It goes and it sniffs that 87.5 and it backs off quick, sharp. It's like bomb to a few contracts and back. And of course, the response to that as well, straight after, is we come back into that bracket of the 80s, 76s, and we start sitting there. We have a little flurry up above the 80, out of 80 to 82.5, and straight back in. That's the key. What's the response when you break out of those little tape brackets that you've pictured in your mind? You've got a mental view, watching price, pops up, comes straight back in, comes back into where it wants to be. It wants to be in that 80 to 80, 70, 76 to 80. It wants that's like a magnet for it. Pops back up again, boom, straight back in. And then you can see the response, and eventually that pull of it straight back in are these persistent sellers sitting there ready to hit this whenever we get these little pops. And eventually the buyer who's holding at that 76 crumbles and it disintegrates and it just falls to the floor, and there's a trade opportunity from that potentially. So it's really understanding where price wants to be, where's the little magnet for price, how it oscillates around the magnet, for want of a better analogy. What happens when it breaks through? And you know what it's like with the actual magnet. When you pull it away, it's still got some pull back, and it chunks straight back into that magnet. And so it's working out in your mind at the key level. We're not doing this everywhere because it's driving us nuts, right? But we're working out in our mind where that magnet is and how it's going to price is oscillating around it. So it gives us a little bit of a clue. Like, hey, every time it rejects that high, that's interesting. It's interesting. For a short-term basis, what's the next trade? Or potentially, if it breaks through that low, it might be worth a go. Tight stop and see if I get a run. See if I get a 5, 10, 20, and get a bit of movement from that. Same type of thing here. We've got Tesla when it was cascading through these lows. We start to bracket this area. We start to see the response of this area, and we start to say, listen, and this is a little of short-term rejection. Short-term rejection to the downside, straight away buying is met, decent volume as well. You're looking for, that would be a buy for you. Now, obviously in this case, if you held it, you end up being stopped out, but it's just bracketing where price wants to be. Where's that short-term magnet that's keeping price there as it coming back and forth. How is it responding? Yes, breaking free of it, right? Where's the new bracket? And then the new bracket's going to be up here. And it's mentally challenging. It's mentally exhausting. It can be, but it's meant to be, because no one else does this type of stuff. Well, no one else, of course, someone else does it, but everyone's looking at the bigger pictures and they're kind of drawing the levels and waiting for this. But this is kind of getting you a little bit ahead of the curve, just a touch early. And does it always work? Absolutely not. But when you can master this skill and you can get good at feeling price, and I'm going to give you some drills to help you feel this price, even if you're thinking of this going, it's difficult to understand it. But when you start to feel it, and you probably do, right? I know you're an active trader. That's why you're here. There's a certain level of feel about price. It can just smells different. There's a difference in the air when the price is moving. When it's in a structured way, or it's in an exhaustive way, or a persistency of trend way, you just feel the difference. And so what we're trying to do is drag that feel into the very, very short term and go, hey, can I feel if price is going to pop out quickly? And if I can just get a head start on that and get some size on, and if it comes back, I'll take it out. But if I get it right, which we'll talk about kind of later on, is we can then really kind of leverage up and get some decent trades from that, potential decent trades. Same type of thing, just chunking it at our key levels. All right. Let's talk about these pulses and pauses. And I know we're going right advanced and we're going right into sort of price structure, but that's the name of the game. Okay, that's the name of the game with this. So when we see I call like the market's got a rhythm to it, right? It's got a rhythm. It's like an ocean. It's like a dance. There's a rhythm. There's a structure. There's a flow. There's a crescendo. There's a pause. There's a calm. There's another crescendo. There's a pause. There's a calm. There's a lull. It moves back. It moves forward. There's that rhythm to it. Yes, it's like a living being, right? And you imagine the market pulsing, kind of 5 handles up, 2 down, 5 down, 1 up. You get this flow, right? You know this. You've seen it. You watch charts, you see how the market flows, and there's a rhythm and a structure to it. So what we're going to do is we're going to come look at how we can really interpret that and use it to generate trade ideas and opportunities. So the pulse is the rhythm. I call it the rhythm and the flow. And the pause is when we kind of have this persistency of trend, and we have the little, and then it goes. Like we see that little like 10 ticks down, 1 up. That's the little pause, and then bang. Then we have 1 up, 1 down, 3 up, 2 down. There's a little pause again, and then a cascade again. And we'll talk about this, on some charts. So here's one, a NASDAQ 15-second chart, cascade lower, little pause. And imagine going back to this, we see the 10 down, 1 up, 12 down. We see the little pause. So it's just sitting there, and we're waiting, and then it overcomes those buys again, and it cascades lower. And if we're watching this and we're ready for this, and it's a key level or it's an opportunity we want, we see it, and we're not diving in. This is the key, right? How many times have we dived into trades and get caught out? That's why we don't want to do it. We want to wait for these pauses, wait for these pulses, wait till because the idea we've got, guys, we're trying to look at the ocean. We're trying to look at the waves. We're not just going straight in and trying to get stuck in. We're looking, observing, and then we get involved when we feel like we can ride the wave. So we might see this big pressure of selling or big pressure of buying, but we wait for a pause. We wait for some structure that we know we can take advantage of and then trade. So we see the drive, we wait for the pause, and then just as it goes again, that's when we're getting involved in it. There's that urgency, and we're just trying to spot the institutional urgency to get involved in. Okay, so if we think about this, go a little bit more into this, these pulses and pauses, think of what the motives of each side are, right? Ultimately, as much as people would like to say that people are driving the market, and now and then, maybe that's true, but sellers want to sell at a high price and buyers want to buy at a low price. That's generally the consensus, right? You know this if you're a trader, and we want a better value price. Now, if we look at this a little bit more in depth and we say, okay, algos are programmed to sell, and then wait, because they want a high price. Because you think, right, we'll go off topic slightly here, but imagine this, right? This is telephone, by the way. Yeah, I want to sell 100,000 contracts of DAX in the next 3 hours. Okay, sir, no problem. Boom, phone goes down. Problem is the algo, extra aggressive. I need that filled in 3 hours. Enter. Algo goes away. What happens? Algo looks and knows roughly what the volume is of that DAX contract over those period of time. Comes in, sells a bunch, starts hitting the bids, needs to get it done quickly. There's quite a lot of volume, right? Starts hitting bids, we get a cascade lower, hitting bids. So it sells to get a chunk of that done, maybe gets 10% done. And then it's like, hang on a second, I'm driving this price lower and I don't want to do that. And this was a flash crash, by the way, but this was happening when all the algos started doing this and it just got crazy. But they'll wait, they'll back off. And then what happens is price pops a little bit. And let's say it stalls, it pops and it stalls. The algo then goes, oh, we found a little bit of a level here. Let me start selling again. And by the way, it might start working offers as it's going up. But then when it stalls, it might go, hey, I need to get this order done. I've got 2 hours left. I've got whatever, we had 800 contracts still to do. Let me start hitting the bids again. And then we get the cascade lower, right? So, you think about what's happening. They're hitting the bid, they're hitting the bid. Then they kind of go, it's gone quite low. And this is all structured in and kind of coded into for people who are brainiacs and really kind of understand the structure. But they're doing this, they're kind of saying hit the bid, and then wait, put an offer out for 25 contracts, 50 contracts. Oh, it gets hit. All right, great, there's a bit of buying pressure. So they're constantly testing, right? They've got this combination of I need to get a best price possible for the client. That's what the algo is trying to do in that particular example, but also needs to get the order filled. So now they will go hit, bid. Market's gone lower. I'll back off. They'll back off. They'll put some offers in the book. They get hit. Then they go maybe offer +3 to see the price reaction. Because ultimately, the best thing they can do is say, you know what? I've got you all that. I've sold you all those contracts near the high of the day. The customer's going to be like, thank you very much. Here's all your bonus. So the algo wants to sell at a higher price possible, but it needs to get it done. So it's creating that time sensitivity and price sensitivity, right? So it goes off for +3, maybe gets hit, goes off for a little bit higher, and this is what we see on the chart, right? We see the drive lower, and I'm not saying it's just one algo doing it, but if we talk about all the participants, bid, market sweeps lower. They go, whoa, it's gone quite far. Let's see if there's any buyers there. They step back, buyers hit the offer. They step back a bit more, buyers hit the offer, they step back a bit more. This is the retracement we get on the chart, right? Now it doesn't go any further. The offer's sitting there, not filled. The algo goes, I've been sitting here for way too long. Time's ticking. I need to get on it and start getting the fill again. And they start hitting the bid again. And or another participant comes in and starts hitting the bid. They're then way away from the market and they need to get some orders done. So they start hitting the bid again. So I know I've said few here because imagining it is tricky, but this is what's going on in the bonnet. This is what's actually happening. So that's the pause. The drive lower, bang, 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 wait, want to get higher price, They'd happily keep paying high and high and keep sitting on the offer as it goes up and getting better and better price. But if that market starts going lower or they're not getting hit, there's no buyers who are wanting to take the futures contracts off them, what are they going to do? They're going to start hitting bid again. And that is what we see in our charts day after day after day. Now, sometimes, markets oscillating around, not doing much. When we see that urgency and that pause, that's really what's happening. Or I believe that's what's happening. Now, who knows? But, with my understanding of structure and algos and all this type of stuff, that's what we're kind of looking for. And if we can think about that, whether we're trading a CFD or a spread bet product, doesn't matter. But we see that on the chart and we try to take advantage of it. This is exactly the type of thing, right? It's exactly the type of thing. Tesla selling. They're backing off a little bit just to see if anyone's prepared to buy it. It runs out, then they come back and sell. Back off a little bit, some buyers, sell. And then you get this finality of order flow, volume spike. That's the last batch done. That's probably because there's a big buyer there and a big seller. And then we see that retracement back off. So, thinking about the pause and why, and again, we're going back to the kind of slide 2 of week 1, understanding the motivations of players, right? We're not just trading against each other here. We're trading against bigger players who have different motivations, why they are moving price, why they're hitting bids, why price is trending. And the deeper understanding we can have from that, the better we can be at understanding, okay, well, if that's what they've done so far, what assumption can I make about the next minute, 5 minutes, 10 minutes? And is that a valid assumption? That's a valid assumption. Is it worth putting some risk capital on? Maybe it is if I can use a stop loss to mitigate any damage. Probably is. And the more we kind of think about this, the more we really spend some time to ponder and consider why price is moving, the more we can understand and play the game of chess and understand, okay, well, if I think a few moves ahead, if I wait for that and I'm correct in that thinking, then we probably will get a flush through there and this, that, the other. So you start to play a little bit more of a strategic game rather than just reacting to price. Oh, price is moving. Oh, let me get on it. So let's talk about pulses now. The market's got a bit of a rhythm to it, right? You know this, it's the waves, talks about the waves. And I think and again, I'm happy to be challenged on this. No one knows for sure why markets move the way they do, but I know there's a lot of algorithmic participation. Even if someone's just executing an order, very often an algo is doing it. If it's even available to retail traders now, they can get access to algos, some sort of just general themes and flows and structure. And we often see this, and you know this, or you've seen this. You might not have kind of consciously noted it down in your trading journal, but you might have gone, hang on a second. We often see this same order of magnitude moves in the same time between extremes. There's a certain symmetry to markets. It's not identical, but there is a certain symmetry. And it's not obvious all the time. And it comes in pulses when they have got this participation of algos and institutions and this type of flow. And then we see some symmetry. And our job as a short-term trader is to go, I see ya, I see you, and strike, take the opportunity, come out of the market, and then let the chop carry on and do whatever it wants to do. It's not always there, but we're looking for it. So with the idea, and if we make the assumption there is some symmetry to the market and there's a rhythm to it, how can we frame our short-term scalp ideas better? Okay, busy chart, I'll admit, busy chart, but let me dissect it out for you. So we've got Tesla here, 15-second chart, fine. look at the structure of this persistent trend. Okay, so for whatever reason, right, and this is why this is nice, this example. So stick with it. End of the trading day, 9 o'clock UK time, right on the right of the chart here. 25 past 8, so about 35 minutes to go, selling program kicks in, or some selling kicks in. I don't know if it's selling program, but I'm going to make an assumption that there's some sort of urgency to this, right? It's trading up at 183.40, ends at 180.20. There's an urgency of like, oh, I've got 35 minutes to get this done. Let's get this done quick. And so we start to see a rhythm and a symmetry to the market. Now, again, just going back, this is not always the case. It's not always there. If you start looking for symmetry and this structure and pulses, you start looking for this framing, the way that it's moving, and reading too much into it, you're going to get caught up. But when you see an unusual type of move, you start to go, okay, let me look at this. You start to say, look at the distance between highs and lows. 3 minutes, 3 minutes, 4 minutes, a little bit sharper. But this is where opportunity comes, right? If we start to see this kind of rotate lower, pauses a little bit, and we kind of go to high, 3 minutes, rotates lower, a bit longer, but then the pause comes in that starts to hold for kind of 4 minutes. Then we see this much more aggressive type of selling, and we see a much more shorter term consolidation or move from low to high. We can start to go, hang on a second, things might have changed a little bit. There's a bit more urgency for the sellers here. They're realizing actually time is not on their side, and they're going to have to get stuff done. And you start to see a little bit more urgency. The responses hit much more quickly. And so when you see this creates an opportunity for us as traders, and we start to look and we start to frame the move and go, hey, hang on a second, these pullbacks, they're really shallow now. They were quite wide. They were giving, going back to that slide of, okay, algos waiting. These algos aren't waiting anymore. They're waiting for 30 seconds and they're getting straight back on that bid because they've got stock to sell. And yes, we might meet a buyer later on, and we end up doing that and ends up stagnating and holding. But at the moment, there's a seller. There's an overhang of supply. Supply is hitting the market, and it needs to be done now. And when you get this perfect storm of closing bell or whatever it may be, and a sense of urgency, we can start to read this type of stuff and go, how long's the pause? The pause was 4 minutes before, 3 minutes before. Now it's 1 minute, 15 seconds. Now it's 30 seconds. Man, and we've only got 10 minutes to go. There's a real sense of urgency here. So we start to see this. And then the same with the price movements, right? The symmetry of price movements, sort of bracketing highs and lows and seeing where prices move from sort of swing point to swing point. We're getting this kind of 30 cent, 35 cent, 40 cent range, and then a much larger range as we come down here. So it's not perfect. It's never going to be that. Of course, it's the market. There's multiple participants in it. But we start to see symmetry, and we start to see when it moves out of the normal, that's when we go, okay, maybe there's a potential opportunity. Same here. This is exactly the same type of thing. Look, from swing high to swing low, 3 minutes, 15 seconds, swing high to swing low, 3 minutes, 15 seconds, right? There's a symmetry to the market. Another example here, we've got this kind of, again, a complicated chart, but let me decipher it. The VWAP is an important level. Volume weighted average price. Algos are looking at that price level. We get 3 tests of that, just like I said earlier, when we saw that, was it SPY or Q? Can't remember, but always always some sort of response at VWAP, even if it just kind of holds and then drives through, very often get a pop off. So there's a response to the VWAP. Dips under, rips high. You'd expect that. There's just kind of swing high on that point. And now we're bracketing. Look what's happening. We see that we've ripped up from the low to the high, 42 cents. Right, and then when we go from that low point back to where we had some minor support, it's 42 cents. And we go, hang on a second, what? That's odd. And then we go, okay, what is it from that level to there? It's a little overshoot, it's about 48 cents, but it's about the same kind of structure. And so when we're framing these movements, it pays for us to understand, how much price is movement. Okay, it's moved up 40. You don't have to be accurate with this. About 40 cents. Right, so I'm expecting a 40-cent move down there. If it starts to extend and the time between pullbacks starts to be shallow, then maybe there's an opportunity. And this is stuff that you start to build. We'll talk about drills in a moment. This is the sort of thing that you start to build your intuition and your skill and experience in watching price. And it's it's a tricky thing to kind of portray, on a chart like this. But when you start to watch it, and you start to feel it, you'll start to see, right? You go, okay, and you start to think, okay, that's a 50-cent bounce. Okay, let me think now, 50 cent, that's holding. And you'll start to go, bing, hang on a second, this is an interesting level. It's a level where people are looking at, whether it's time, whether it's price level, and we're seeing some sort of symmetry to the market. Okay, how can I use that to my advantage? If I now see I chunk my price and I see it break through the bracket, should I expect at least a 40-cent move? Probably. That's probably a good thing to shoot for. And if I'd see more than that, is there more opportunity? So it's just framing kind of normality. And it's the same thing with the higher time frames, right? I've jumped the gun, but here you go. How can you use it? You see symmetry to the market and you kind of say, that's the norm. When the rhythm starts to kick into gear, I go, great. I see a 40 pip drive lower, 12 pip pullback, and you're on that pause. You see that pullback. How much are you going to target? For me, I'm going to look for at least 40 pips because that's the structure that we have in the market. It's a bit similar to the flag type strategy, right? You on the 1 minute chart, 5 minute chart, the pole, and it's a measured move type thing, but on a very short term basis, the pole tends to be kind of your target when you have the flag break. It's the same type of thing, but we understand why now because it's the algorithms. Again, my belief is that it's the algorithms that are doing this and a testing structure backing off, and they get to a point where and they come back in again, and that kind of gives us all this opportunity that we can potentially capitalize on. All right, let's move over to drills. So I know there's a lot covered here, man. I've just gone bong. I've just turned on this hose and gone, have that. And you've just gone, geez. And, if you're still here listening to this, you're going, man, there's a lot of information. But I think that when you start to look at price yourself, that's when you'll go, I get it. Okay, I can see that. And it'll start to become clear. Have you ever done those magic eyes? Your magic eye? Like you look at the book and you look at it and you go, you can't see anything. But when you stare at it, you look through it, it kind of comes in. It's a ship or it's a tiger or it's that. I remember seeing those for the first time and going, man, people are scamming. It's a scam. This guy said, oh, you can see this thing. But then when you really kind of look for it, then it shows up. It's a little bit like, I think it's a little bit like that to a certain extent. So watch price around the key levels, okay? Or you're going to burn out. I promise you, just go, I can't do this anymore. I'm going to burn out, or you'll lose patience, or this type of stuff. Just watch how price responds at the open. Yeah, the open, if you're trading something that has a specific open, and the closing 15 minutes. And even if you're trading a Forex pair, maybe, when that transition occurs, or maybe when they get the London close, all this type of stuff. Prior highs and lows, really good levels to watch. Do your chunking, see the price pauses, pulses. Just get a feel for it. Note stuff down. Maybe record some of this type of thing. Today's high low as well, obviously key level. VWAP, volume weighted average price, big fan of that because institutions use it. And I'm interested in what institutions think and how they feel. I know it's a benchmark for them. I know they respond to that level. I know algos are programmed to respect that. So whether I like it or not, I'm going to respect that. And I've done some sort of deep dive into that before the VWAP. And then multi-day swing levels, because that's a level everyone's looking at. And we're watching how price responds around those areas. And these are 4 things we're looking for, okay? Looking for the speed of price as it runs to the level. Is it slamming straight up to it? Bang, 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 bang. And what's happening when it hits the level, right? Is it just going slamming up to it, boom, stopping dead, right? That's the response to the level, stopping dead. But then what happens? Does it pause there? Does it hold there? Do we get like 15-second chart just sits down there? Or does it pop straight back off? Now, nowadays, we tend to get it running through because, I'd say olden days, Jesus, I sound like I'm Jesse Livermore. Years gone by, algos will just sit at a level and they just reload, right? Let's say they sit at 50, they just go boom, 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 they begin hit, they reload. But now they're much smarter. Like, hang on, if someone's hitting me at 50, I can get 49. If someone's hitting me at 49, I can get 48. If someone's hitting me at 48, I can get 47. I want the best price possible, going back to that point. So algos now have programmed, and also just not algos, but even not weaker algos. I'm talking about less sophisticated algos that are maybe limit orders. Yes, the limit order will sit there, and it's got 100,000 contracts. Will sit there until it's filled, and it might just show up as a fat line. But anyone who's trading 100,000 lots on something that's can't normally accommodate that sort of size, will have some sort of dynamic adjustment to it. So the price will run through, then maybe get filled in a bunch, and they'll go lower and lower and lower and lower until they don't, and they'll come back up, just like we talked about earlier. So what's the price response to the level? Does it rip through? Does it pause? Does it hold? Now, what's the secondary response? Think of this in the multiple responses. Don't just go straight into it. It's a mistake. I believe it's a mistake. Wait for the secondary response. Does it pop off? Does it hold again? So price response, initial response, what's the second response to it? Does it come back? Does it test it? And the third response, is it a trend change? Does it break out? because structure often changes at levels. Even if it just runs straight through, often it's going to accelerate harder. Maybe it's going to change, because if you think about price going through a level, it comes to a level, maybe it's running right to it. Maybe it breaks through it. Maybe it's a little bit shallower. And that might be indicating that there's less supply coming in, but there's still overwhelming demand, in which case you can be smart and think, hang on, it's changed. It's changed fuel. Yes, there's still some overhang there, but there's much more buying accommodating that, and it's kind of really shallowed out price a little bit. Maybe we're going to get a pull back up as opposed to that sharp drive and pull back. So there's lots of things to think about and understand. But if you watch speed of price, response to the level, subsequent responses after that, that's when you start to read and start to feel. And if you use that chunking method to kind of filter out the noise and go, hey, it's trading between these two levels, forget about the middle bit. I just want to feel how price responds and then see if it breaks out, does it immediately come back in? Does it do this? Does it do that? And don't act on it. The first time you kind of do this, don't act on it. Don't be kind of go, oh, this sounds great, I'm going to put my capital on it. Absolutely not. But you start to feel and read that under certain conditions, there's a symmetry, there's a structure, there's a certain edge that I believe that we can have as short-term active traders that gives a little bit more insight into movement. Then it might just be an extra sort of skill that you add, and you go, hey, I've got my structure, I've got this idea, I've got this trade, it's a broader theme, but actually I'm going to really kind of narrow it down and try and just get a slightly better price on this, try and really understand how price structure is affecting the patterns on the chart. So summary, 15-second chart, handy tool to have in the arsenal, I believe. Use it when you need that finer detail on price. We don't look at it all the time. When price changes pace, so when we see that kind of structure change, when the rhythm changes, when we talked about the rhythm and the symmetry, when it starts to change, when it starts to change price, or it starts to change that structure, when it starts to change the flow, or hits the key level, then we do the bracketing, we do the chunking, and then what are the short-term levels that matter, and getting good at that. And then one of the ones that I love, and you guys follow me, that this is, I love this type of stuff. When we get the drive and the pause, what happens then? When it pauses after that drive, what's the response? And if you are following the trade, you see the momentum, and it pauses, and it's holding, and it immediately kind of moves any bracketing. You're like, hang on, it's held, then it breaks out that mini bracket straight away. Often that's going to be the next leg. Always, but often. But if you can structure a stop in it, then you can take the trade. And then price has been moving, there's a rhythm and a structure to it, and reading that the more. And when you're open mind, let me tell you this, when you come into the market as a short-term trader, and when you look at it through a different lens, and you say, hang on, I've been looking at it through a lens of technical analysis and trying to do this, and absolutely that plays a key part. But when you change the glasses you put on, you go, hey, I'm just going to look at it and see if I can find some rhythm, structure, and symmetry to these moves. You start to see like the magic eye thing. And again, I'm being very mindful not to say this is something that's not. It's not something that's just going to revolutionize things, but it's a skill that when you do start to look through a different lens, and you start to say, what's the rhythm? What's the symmetry? How does price respond? Rather than just being so binary at it, you start to see things that others don't. And I believe then that gives you the opportunity to potentially get on a little bit earlier, or like I said at the beginning, just not take a trade that just is not going to work out. Or let me measure that. Let me say a trade that has you believe has got a less probability chance of working, because you see this, you go, I don't like the look at that, it's holding at lows, man, it could just, of course it could change, big buy could come in at any point in time and change its structure, of course it could, right? We see that all the time. But if structure continues as you read it, then the likelihood is probably going to go a little bit lower and maybe get a better price. If you still want to take the long, at the very least, or the best, you go, okay, I'm going to avoid it altogether and be done with it. All right, next session, talking about counter trend exhaustion failure, rules for spotting that flush, a little bit more detail on the stop hunting strategy we talked about at the beginning of the first webinar, 15-second trim and trail. This is where we're really kind of trying to, trading these stops and the 15-second chart, some of the strategies around that. Talk about turning these scalps into day trades, into swing trades, or potential swing trades, or at least magnifying the R multiple. R multiple, I mean, like risking 1 to make 10, to make 15, or to try to squeeze as much as that as possible. And this is where we can really utilize that. And then I'm going to give you access to that Amber scalping tool that I've had coded up, how to access it, best practice for configuring the tool. All right. If you haven't checked out my daily email, guys, tradersmastermind.com/ email, send an email every day. I love writing those. You guys love receiving them. A lot of stuff. I know that's advanced and a lot of stuff. Let's have a look at the questions. If you've got any, I'm sure you have. And I bet the first question is, will it be recorded? Because you went through so much stuff so quick and I want to read it again. Adrian says, will it be recorded? Yes, it will, Adrian. You will get a copy of this if you've signed up and registered for this webinar. You will absolutely get a copy. Victor said looking forward to it. I don't know if you still enjoyed it after that, Victor. I know it was a lot. I appreciate, guys, there's a lot of kind of a unique perspective on things, and I try and give you a lot of information that I find valuable. And your job really is to go, hey, I don't like that, but I really like that idea. Let me take that and kind of make that my own. And if that's what happens, then that's my job done. You know, my job is to say, this is what I feel is valuable, and you go, yeah, I like that, and take it. And if that improves your trading, then man, that's job done for me. Good to see you too, Daniel. What have we got? We've got loads of questions here. Can you use the 15-second hack regardless of what time frame you trade on? Yes, Angela, you know, I think so. Now, one caveat to that is that if you're going to be seduced into over trading, then don't do it, because discipline is the most important thing, and it's something we focus on loads when Traders Mastermind guys know watching this. It's important. It doesn't matter how good your edge is. If you end up doing stuff that's out of your edge and punting away and taking substandard trades, it's irrelevant. So the caveat is yes, but understand what you're doing here, and understand if it's, and again, I'm going to be brutally honest, is it worth it for you? If you've got a swing strategy in a higher time frame edge, Angela, that's working for you, then do you need the granularity of the 15-second? It might work for someone, but maybe it doesn't work for you. Maybe you're like, okay, you know what, I've learned a little bit, but maybe I don't want to implement it, and that's fine. That's cool. That's part of the game. But if you think, hey, I do actually execute on a lower time frame, I wouldn't mind kind of fine-tuning the entry a bit and turning it into a longer-term trade. Next week, we're going to talk more about that, but it might be something. But again, I'm not standing here saying you absolutely should do this. And if you're a higher time frame trader and you think it doesn't really apply to me, then that's absolutely fine. I've been in this game long enough to recognize that there's more than one way to play this game. Okay. Let me go here. Why have I got a very small window? Chris has said, can you give a working definition of chunking? It is different than short-term range like a flag. You know what? That's very astute, Chris. It's similar, right? It's similar, but what we're kind of doing is, rather than we're looking at a pure flag and saying there's a support, there's a resistance, it's that type of thing, but we're kind of bracketing the short-term highs and lows in our mind rather than look at them visually. And I kind of use some visual examples there, and perhaps I shouldn't have. But really, when you're watching that price movement up and down, up and down, up and down, you're thinking, where's the high, where's that low, how does it respond? And you're kind of really looking at a real short-term basis and going, okay, it's how long does it stay in that? What is the response to the top of it when it pops out of it? So in a way, you're right. It is not dissimilar to a flag on, say, a 1 minute chart or whatever, but we're kind of looking at short-term base, and it might not always be in a flag position like at the end of a drive. It might be that market kind of drifts up to a level and sits there, and it's a key level still. That's not quite as juicy, but it might still be something. I understand the price bracket is key, but does the duration of time prices constrained by the range indicate something as well? Absolutely, Chris. Bang on, buddy. If that's sitting in that chunk, if you've got the bracket is sitting there, what do you think's happening? There's just an acceptance of price. When there's an acceptance of price, and the more time spent in that level, then the more arbitrary the breakout's going to be. Could break up, could break down. It's almost like now on the higher time frame, right? The market could go high, could go lower. Yeah, maybe there's a short-term uptrend, but there's long-term downtrend or medium-term downtrend, long-term uptrend. You kind of go, okay, maybe my edge is diminishing. And I feel the longer it stays in the range, especially if we're chunking on a very short-term basis, the less the edge is, right? The less the edge is. So, finally, running down to hit the chunk, price pokes below multiple times, but it's constrained at the top. Is that more of a short signal showing prices willing to go below, or long signal because there are buyers below? That is a really good question. Yeah, I think the more it kind of tests, now this is where it gets interesting and maybe a little bit complicated and contradictory. But if price is testing lows, and what's the response? So if it pops, so that's a great example, right? Because let's say you've got a 50, let's call it 50, right? There's your little chunk. and it comes through, it dips to 49, 48, and pops back up, but only stays at 50, 51, right? That to me, that's bearish, because it's popped through, overshot. There's still some buyers. We haven't completely resolved that yet, but it's not completely gone. If it then goes through and then rips straight back up, that is turned to bullish. I know this is very intricate, but to me that indicates, okay, we've gone through, we've found some buyers, and now those buyers are stepping up, and maybe the sellers are lifting. And so there's a difference. So it's a response. If it just dips below, comes back up, dips below, comes back up, and the right conditions, to me, I interpret that as bearish. If it dips below and comes up and then pushes to the high of that chunk, that's bullish, in the context of obviously of the price and stuff. But that's a really good question. It's a really important question. And the more you kind of do the drills, the more you kind of look at price. I know you're a crude oil trader, Chris. The more you kind of watch this type of stuff, the more those questions are quite smart. And that probably indicates to me that you've actually kind of watched this stuff and see how price responds to different areas and different levels. So yeah, that's a good question. All right. How would you differentiate between a 15-second pause in algo selling versus the 15-second pause after a stop loss area is triggered? There's a bit of difference in vol. Yes, the pause to me, and again, listen, someone will stand here and say there's definitely this and definitely that. All we're trying to do is just swing the odds slightly in our favor. We can't say with certainty, but we can go, oh, that really smells to me like it's that. And that's what our stop loss is for, right? It's why we don't just bet the farm on every trade and go, it's definitely stop, or it's definitely this. So we've got a little bit of guesswork there, but good question. We're going to have 15-second pause in algo selling versus 15-second pause after a stop loss there. Okay. I always look at it like this. If it feels like there's more to go, and how do you quantify that? If there's a key level that's in sight, if there's a magnet in price, if there's a closing bell, something that might indicate price goes further, and maybe it hasn't gone so much yet. Maybe there's still the low of the day there. Maybe there's still a swing low. Maybe structure's not completely broken. It's not a massive move. Then I would be like, okay, is there any reason to suspect a stop loss trigger? Is it a key level, or is it a pause in between going from an A to B level? If it's a move from A to B and it's a pause in the middle, I might be more inclined to think, hey, even though there's a similarity, you point out, there's a similarity in that short-term structure, slightly zoomed out view is that actually there's possibly more to go. And this is where you kind of make a little bit of a judgment, right? You go, where are we? Are we at a level? It's very different to it running and finally breaking through like a week low, and then you see that flush, big volume. Response to that is maybe a pop up. You go, that feels flushy, that feels like exhaustion, versus it's just getting started. You got the end of the day come in, maybe there's a gap fill or one of those magnets that's kind of sucking price in, and then you see that little 15-second bracket and chunking or pause. And you go, hang on a second, the logical explanation for this, or logical resolve or resolution, good word, resolution of price, is probably to the downside. I'm still going to manage my risk. I'm still going to put a stop in place, but I've seen that. I'm going to wait for that chunk to break, see the response. Every little pop gets sold, little pop gets sold, little pop gets sold. Test to the low, no buy, and then the cascade continues. Mark said, had the pulse on WTI West Texas Intermediate. I shorted since yesterday and was still short, but then saw a pulse brought at 76.51 to 77.43. That's a nice little trade, Mark. Well, decent trade. Little break, made a grand on trailing stop loss while my longer short was still running. So hats off to you, as I'd never have done that before last week's session. Good, thank you, Mark. I'm really glad that you're kind of implementing some of these tactics and making them your own. Making them your own market, your own style. And that's all I can ask for sharing my knowledge. Jacob says, great webinar as always. I'm glad you enjoyed it, Jacob. Is there a strategy trading idea that's worked in more or less the same form throughout your profitable career? Stuff like flags, stuff like, the momentum. If you can spot momentum ignition, right? If you can be there and you can spot momentum, you can decipher this momentum rather than just a pulse and a mean reversion. These are stuff that stands the test of time, because if you think about what that is, that's institutions or buyers or sellers, whichever way you look at it, who have to get orders done. They have to get stuff done, and they can disguise it as much as they want, but if they need to get stuff done by the end of the day, they're going to get stuff done. And if we can spot that type of thing, this is not the environment for it now, by the way. Maybe there's a little short-term basis, and Mark gave an example of that, but I think that is stuff that's always going to be there. It comes and goes. It's always going to be there. As is, just stop loss trading, the stop loss hunting, for trading exhaustions. People are going to have stops. People are going to get panicky about stuff. People are going to be time sensitive and not price sensitive, not care whether they get out of 70, 69, 68, 65, 62. They don't care. And if we can we can spot that and take advantage of that, that's always going to be there. Unless brokers change and be a bit more smart about how they execute stop losses. It's interesting. Would they ever do that? I don't know what you could do. You can use a stop limit, of course, but then you can end up being stuck. Excuse me. 15-second chart is available on TradingView. Does it work on higher time frames? Yeah, you can use the same type of thing. Absolutely. 1 minute chart, 5 minute to a certain extent. It's a slight different feel to it, and the response is slightly different. But yeah, you absolutely can. I think you came at the end. Maybe you did, Nathan. Recording will be on the way. Thanks to the webinar. A lot of insights into my trading technique. Thank you, David. Victor, do you keep a watch list or focus on just a few assets? How do you filter up from which chart to follow? I watch the main markets, watch SPY or S&P, and I watch NASDAQ, and I watch Dow, watch a little bit of DAX, and I kind of see what's going on. But then earnings season coming up at the moment, obviously we're almost in the thick of it, right? I like to see if there's any opportunities there, multi 1, 2, 3 day move, or an intraday reversal. I quite like the intraday reversals when we see like a negative earnings or a negative gap lower that finds a bid sort of middle of the morning, rallies back up, holds above the VWAP, pushes above high. I'm going into way too much detail, but yeah, that type of thing I like. Anything that's in the day, Victor, right? Our job is to go where there's supply-demand imbalance. And yes, we don't want to spread ourselves too thin. And I was looking before I came on the call, I'm thinking, stuff's really shifting around, not doing much. And then like sugar is breaking out. And just interesting. I'm probably not going to trade it. I can't remember the last time I bloody traded sugar, a decade ago probably. But we've got to be careful not to spread ourselves too thin and start trading stuff that's really not in our wheelhouse. But at the same time, we want to become a specialist at some type of structure or some type of market or some type of setup or strategy. So maybe having a basket of stuff to watch, is a good thing. And then once they're out and they're not doing anything, you leave them. But I love the main markets. I haven't traded crude oil for a long time though. Helena said, I love the daily emails. Oh, I absolutely love the daily emails. Thank you. Oh, no, thank you. I'm glad you enjoy reading them. I really enjoy writing them. I thought, daily email, I'm asking Tim, but actually I really enjoy writing them. I enjoy thinking about the concepts of trading, sharing them, and then I've got Technical Tuesdays. It's kind of evolved into, some structure and stuff. So yeah, I'm glad you like those. Thanks for feedback. And by the way, you can reply to any of those emails. It will get to me. The feedback will get to me, and I'll take it on board. Okay, to run through these now. Leonard says, is it possible to scalp using 15 seconds or just an entry? Yeah, absolutely. Absolutely, Leonard. Scalp it out. Up to you. And in fact, that might be the way you want to operate. Like, hey, I spot this, I take it, a very, very tight stop, it goes my way, I'm done. Now, I think the lower the time frames you go, the more that obviously commissions, even though the spreads are ridiculously low these days, they start to add up. And I would always think about how you can hold for a trade. You've done the legwork, right? You've got the great entry. You want to kind of don't waste it by throwing it away straight away. Maybe you scalp out half and trail some. I'm going to talk about that actually next week. That's a good question. Will there be another session? There will be another one next week, same time next week, 6 o'clock UK time next week. Excuse me again, talking too much and too loud, with new topic, or the same topic, but a kind of extra, the next level of the topic. But the recording will be sent to your email, Nathan. Yes, the links to the webinar was sent out in the emails. You have to register for it again. You register once, they'll all be sent out. Lamek. Steve says, great explanation of algo price action I've heard. Thank you, Steve. Appreciate that. It's a difficult thing. It's difficult, right? It's risky stuff, but I know that you guys like active trading. If I can just share some of my knowledge and you can pick some of it, it's a good start, and you can use it to go away and kind of use it as a head start to learn your own kind of understanding. Yeah, it'd be interesting to see how you can implement it in your current strategy. That's exactly right, Steve. Exactly right. Now, Steve, if you're from Cheshire or your surname is Cheshire, you're probably from Cheshire. Is this strategy applicable in Forex? Yes, it is. Does this only work for the trending market? No, but more of a volatile, explosive market rather than a range-bound, quiet market. Can you use Forex pairs to illustrate examples in the next webinar if possible? Yeah, you know what, Lamak, I can. But end-day price is price, right? And I don't trade much Forex myself, so I can only do stuff that I And now and then I'll put up some charts of Forex because I know that people like to trade Forex and nothing. I think it's a great opportunity. There's lots of opportunity in Forex. Spreads are tight, all this other stuff. But I like the indices, the stuff that I see, observe. I go, oh, that'd be good for webinar, and I grab it in real time and stuff. But I'll make an effort to try and do that. Can I get free access to 15-second charts without subscription to premium trading view charting package? Peter says. No, I don't. I didn't realize it was you had to pay for it. But how much is it? Trading view? I don't know. Might be worth maybe to get a free trial. I'm not sure. I think I've got the full fat version of trading view. I didn't realize you couldn't get it on free. Where else could you get it on a 15-second chart? I'm not sure. It might be worth trying out, Peter, and paying for the 1 month. See if it's right for you. John says, enjoyed the webinar. Thank you. I missed last week. Is the recording available? Yes, John, that should have gone to you. If it hasn't, just send an email. Pepperstone will send you the recording. Nice webinar. Thank you. Thank you. Loving the daily emails. Appreciate that, Ez. This works on Forex. Gordon says, yes. What are the best VWAP best settings? I'll go through that another time. That's a good question. Thank you so much, Mark. Thank you, ladies and gents. Surname, all right, Steve. Good surname. And Paul says, hi, all right. Hope you enjoyed it, ladies and gents. So we're back in next week. Recording will be sent to you. Enjoy trading, keep the risk managed, and I'll see you in the next one. If I can find the button to quit. Thanks for joining me. Bye-bye.